Ladies and gentlemen, welcome back to the channel. My name is John. I got options, and today we are going to discuss Q2 earnings for Amazon, because Amazon is one of those companies that I think stands out from the rest of the hyperscalers, because Amazon has their hand in everything. They got retail, AWS, advertising, and they're going to get into the orbital satellites to start competing with Starlink. So they are one of these companies that you really have to pay attention to. And for once, Amazon is trading at a very reasonable valuation, in my opinion. Not financial advice. So let's jump into the numbers and let's dissect this earnings report, because I think it was absolutely amazing. Andy Jassy, the CEO, is an incredible communicator when it comes to these calls, and I think some other CEOs, Elon Musk, should take note. But anyways, let's jump right into it. So Amazon's revenue came to be $200 billion, $200.6 billion to be exact. Revenue growth was 20% year over year. Revenue growth quarter over quarter, that means literally from 3 months prior to this 3 months, grew 10.5%. That's insane. Now, why did the revenue grow 10% in 3 months? Literally from the quarter before. Because that's massive growth. Why? Because chips, AI, compute, AWS. AWS is their cloud business. This is their bread and butter. This is where they started it all for the hyperscalers. So EPS growth grew 242%. But there's a little asterisk with that, because a lot of that had to do with their holdings of Anthropic, because the way it works with public companies is when they own a stake in a private business and the valuation of that private business goes up, they have to mark that as earnings, even though it's not real. We have to back that out to really get a crisp understanding of what the business is doing. So their operating income was $27.5 billion, but their operating cash flow was $45 billion. Now, their operating margins, which is based off the operating income, was 13.7%. So that is a very, very important number that I love to look at, because it tells me how nice the business is, how great of a business it is. So for $100 that they collect in revenue, $13.7 is left for them after everything is paid for and taken care of. Now, operating cash flow year over year grew 40%. Operating cash flow quarter over quarter grew 75%. Free cash flow was negative $7.7 billion for the quarter. That means their bank account went down $7.7 billion. Why is that? It's because they are investing so heavily in AI, because they have such a massive backlog for their cloud services that the quicker they can bring these GPUs online, bring these chips online, the quicker they can get that backlog into actual revenue and actual earnings and actual money for the company. Because right now it's a race between all the hyperscalers to clear out their backlog, because Anthropic, OpenAI, all these companies, they are hitting up Amazon, they're hitting up Microsoft, Google, and they're saying, hey, we need compute. Put us on your data centers. We're willing to pay you some money. And the first one to tell them, yes, we got a spot for you right here. Here's some GPUs for you. Then they're going to go with them. So they all have massive backlogs, and they need to bring the compute online faster, and they are willing to spend more money than they are collecting in the quarter. So essentially, Amazon spent an extra $7.7 billion that they took from their bank account to add in to get more of this compute online faster. Now, what is amazing about Amazon is the valuation that the market is giving Amazon currently, because Amazon is notorious for trading at an insane valuation. But recently, as of this last year and this year, Amazon has traded at a nice valuation. And by that, we would look at the market cap, and we would look at the revenue, we would look at the market cap and the operating income, and you get to a company that's trading at 27 times their operating income. That's even after this pop after the earnings, because they popped up a nice 20% as I'm recording this video, 21% from this earnings, which is amazing. So let's dig a little bit deeper into this revenue, because I said $200 billion in revenue. $116 billion of that came from North America, 42 billion came from international, 42 billion came from AWS, their cloud service. Now, what is the growth for each one of these segments? North America grew 16% with an operating margin of 7.5%. International grew 15% with an operating margin of 3%. AWS, on the other hand, grew 37% year over year. Massive growth. This was the main attribution to their 20% pop in the stock, because the market is saying, oh my goodness, they're not growing at 15, 16, 17% anymore. AWS, they're growing at 37%. We're back to this crazy growth because, like I said, the quicker they bring these chips online, the quicker they can monetize all that backlog. And guess what? AWS's margins, 39.4%, nearly 40% margins, absolute monster. So the business that they have with the largest margins by far, also, well, not including the ads business, we'll get into that, but this business has 40% margins, absolutely massive, and it has the craziest growth, 37% growth. So combined, that gave you the 200 billion revenue at 20% year-over-year growth. Company-wide, their operating margins came out to 13.7%, which is massive because years prior, their combined operating margins was under 10%. And then we got to 10%. I think we were at like 12, and now we're at 13.7. So we are getting into a business that's actually making pretty good money. It's not just doing crazy revenue and not showing anything for it. We're finally starting to see something for it. So now let's look at that 200 billion again, but we're going to break it down into their different segments. So not by geographical location, but by their actual business. So we have the retail, then we have advertising, and then we have AWS. So retail was 158 billion, was 16% growth. That's amazing. These are amazing numbers. Companies like Publix, Kroger, Walmart, they need to watch out because Amazon is coming after them heavily when it comes to food and things like shaving cream and razors and shampoos and all these things you buy for your bathroom, for your kitchen, cleaning products, detergent. They saw massive growth in these items. These items actually grew more than the 16% that the entire retail business grew at. So they are taking market share from, your local grocery chains, which I think is a very strong business. It's a very dependable business. And I think that's only going to grow because putting things like shaving cream on a subscription with Amazon is just so much easier than saying, oh, I'm out of shaving cream. Let me run down to CVS. Let me go grab some shaving cream. It's a whole process. When I can just put it on a subscription and it arrives every month, my shaving cream's there. Oh, I got too much shaving cream. I'll skip next month. It's so easy. It's so useful. It's such a great business. So that's growing at more than the 16% that the entire retail is growing at. Now, retail's margins are now at 6.3%. And if you understand Amazon and retail, this is never going to be a 40, 50% margin business, obviously, but 6.3% is very good. That is very respectable operating margin number for their retail business. Now, advertising. Advertising is a business that I was pounding the table about a year ago, 2 years ago, and that business is now nearing 20 billion, $19.8 billion in revenue in the quarter for advertising. So annualize that, you're at like 80 billion a year in revenue from advertising. And guess what? The margins on this advertising business, 70 to 80%. So when you're seeing ads in Amazon Prime, that is where this money is. The beauty of Amazon's advertising business too is that when you are watching a movie on Amazon Prime, you're seeing an ad for Clorox, and then you're going to go on Amazon's retail business, and you're going to go buy Clorox products. So they're double dipping. It's just genius business. Anyways, that's an amazing business. 70 to 80% operating margins, growing at 26% year over year. Now an annualized at $80 billion a year business. Now, the last business, arguably the most important, the one that everybody on Wall Street is looking at, is AWS, their cloud business. $42.8 billion in revenue. The growth was 37%. Absolute mic drop moment for Amazon right there, because this business was growing in the high teens, 20%, and now we are back at these crazy growth levels. 37% year-over-year growth is absolutely phenomenal for Amazon, with margins now at 39.4%. This is great. And the company is trading at 27 times their operating income. So just a phenomenal business, growing very healthily, 20% revenue growth. This is a business to own. This is a business you put in your mother's portfolio. You sleep well at night. Just a great business. So now, the question you might be asking is, okay, why is Amazon trading so cheap? I understand it went up 20%, but it's still cheap as a business with this crazy growth. The reason it's so cheap is because of the free cash flow. So Amazon has decided that they are going to sacrifice the short term for long-term gains. And when you are a long-term investor, that is music to your ears. So when we look at their free cash flow, the analysts are projecting 2027 to be minus 1.87 in free cash flow. So why are they running the business at a loss? Because they want to bring on this compute as fast as possible. That is the most important thing, is to get that backlog down and turn that into real money for the company. So we are now looking at 2028 to be the year that we go back to free cash flow positive, because we were free cash flow positive in 2025, and 2026 we're going to end the year free cash flow will be negative. 2027 free cash flow is looking like it's going to be negative, and 2028 we go back to free cash flow being positive. But the thing is that we will be going into 2028 and we're expected to do $3 per share in free cash flow at an insane growth rate of 265%. Obviously, that's because you're going from a negative number to a positive number. So this is why the company is trading so cheap. We are having a momentary time period where you are able to grab Amazon when the free cash flow is negative, because the short-term traders do not like negative free cash flow. A lot of algorithms, hedge funds, things like that, they are automatically going to sell businesses that have negative free cash flow, and they're going to shy away from these businesses. That is great, because it's giving you a buying opportunity in a great business for the long term. Now, not financial advice. I'm not telling you to go buy Amazon. I'm not telling you to do anything with your money. You do whatever you want at your own risk, your own financial risk. Do your own research, do your own studying, due diligence, all of that. Anyways, the point is, I have loaded up on call debit spreads for Amazon for 2028, December 2028, at the 350, 360 spread, I believe. And I'm now up on those debit spreads, but I'm going to hold those debit spreads. I'm not going to sell them. I'm going to let them ride, because I think that they will hit their max value. I think Amazon will easily be trading over that 360 level by the end of 2028. Because the way I would look at Amazon and try and get an understanding of the price and where the stock will be, I think the best way to look at it right now, considering that free cash flow is negative, is by looking at the operating cash flow. So their operating cash flow, they like to trade between that 15 and 20 times free cash, operating cash flow range. That's just where they like to trade. Going back to April 2025, they were at that 15 times, and they hit about that 20 times a couple times in October, and in May, they were at that 19 times operating cash flow. Right now, they're trading around that 18 times operating cash flow. But when you look at the growth of their operating cash flow for 2027, we're looking at 36% growth in that operating cash flow. 2028, we're looking at 35% growth. So if the stock trades in this range, we should roughly see that type of move over 2027 and then over 2028. If we get to the end of 2028 and the stock is trading at 17 times operating cash flow, and we do $30 per share in operating cash flow, that would put the stock at $512, which would be well over my call debit spread of the 350, 360. I may add more. We'll see where the stock trades. Maybe the stock comes back down and I can load up some more, because there's some other options in the market that I'm interested in as well. It's not just Amazon that's doing so great. We have companies like Palantir that are doing amazing. We have companies like Zeta Global that are doing amazing. And I'll be making videos about those shortly, and you should check those videos out as well. So if you enjoyed this video about Amazon, if you're excited about Amazon, drop a like. If you like this channel, if you want to see more videos like this, if you want to see my video about Palantir and Zeta, make sure to get subscribed to the channel, hit the bell, all of that good stuff. And make sure to check out FeedMeTrades.com right here, where you can track all of your option trades, because I made this website for myself because I said, hey, I need a way to track my option trades that's not directly in my brokerage account, because I want to see how my options are doing separate from my long-term positions. I don't want to see all that together. I want to break it out. So I made FeedMeTrades.com so you can track all of your option trades. Make sure to stay healthy, stay wealthy, and stay tuned for the next one. Peace.